all of it together is a big deal. If you took out any sort of half trillion or $1 trillion chunk of the deficit, that would meaningfully impact some of my macro outlooks, for example. Um, and what really comes down to is what groups are receiving it and what propensity to spend or what velocity do those have, right? So something
Mhm.
like food stamps or stimulus checks, they're going to circulate a lot quicker because they're going to people that are kind of break even to begin with. And so most any extra income they get, they're going to spend. Whereas if you're wealthy and you get extra income, you're if anything, you're likely to put it into financial assets. You're more likely to get asset inflation than consumer price inflation. You're not going to like buy more energy or buy more groceries because you have more money. You're going to buy another property. You're going to buy more stocks, for example. So those details matter. The ongoing large expenditures in Social Security, for example, they're a big factor. Because now that's operating at a loss. There were decades where they were taking in more money than they were expending, but now that they've hit this kind of demographics cliff, where there's kind of, the baby boomers have entered the bulk of their retirement years, kind
Yeah.
of at scale. And so that's actually another really big factor because those are inflation adjusting liabilities. Um, and so, as that money gets out there, and it's more than they're taxing in, they're spending. And so they spend, they contribute to inflation, inflation goes up, and then that adjusts higher. And so when people talk about, for example, demographics being disinflationary, for many decades, for a long time, generally older age was pretty correlated with poverty because you'd lose your active income, and if you were not the type that had a lot of savings, you would run in, you're not starting a family, you're not expanding your house size, so your consumption's going down, and overall your income's less. But if we're in an environment like we are now, where a lot of the wealth is in the higher third of the population in terms of age, and then if they have a lot of income from these programs as well as from their asset savings, their propensity to spend is not really going down a whole lot. They might not be upsizing their house, but they are going on vacations. They are eating at restaurants. They're contributing to their kids and grandkids' weddings and helping them get a house. And, so that money is to some extent circulating. And so I
Yeah.
would say that those are, and then, yeah, the Reduction Act, some of the construction spending that's contributed to, all those pieces together are collectively, I would argue, inflationary and to some extent stimulatory, at least in nominal terms, in different parts of the economy.
In a recent analysis, finance expert Lyn Alden highlights concerning trends in the US economy. With rising deficits and significant demographic shifts, the landscape is evolving rapidly. Alden emphasizes the impact of stimulus measures, noting that their effectiveness varies based on recipient demographics. Wealthier individuals tend to invest rather than spend, exacerbating asset inflation. Meanwhile, ongoing Social Security expenditures and inflation-adjusted liabilities add pressure. Alden warns of a potential tipping point, where rising populism intersects with economic strain, impacting essentials like groceries and oil. This gradual shift signals a turning tide in global financial strategies, with long-term implications.
So I think some of that is nonlinear because when you get rising wealth concentration, you start to get rising populism, and of course that can take very different forms. There's left populism, there's right populism, and the way it starts out is some people have legitimate grievances, but then of course it often turns into extremism,
Yeah.
and so you get kind of like rational populism, and then you get irrational populism, um, and so basically the past 40 years there's been this game of like global financial blackjack where the best strategy for the most part has been to borrow fiat currency, you're shorting fiat currency, which is abundant, and you're using it to buy assets. So real estate or business equity primarily.
Hmm.
And if you can, so in blackjack, you want to get as close to 21 as possible without going over, right? And so in global financial blackjack, you want to borrow money, buy assets with it, but not so much that you blow up in a recession. You don't want to be in the first wave of entities to go down in a recession. You want to be, firmly behind the pack so that, by the time you're in any sort of threat, the stimulus is already happening and you're able to get through it. And we've gone through about 4 decades of that. And the reason it's global is because there's a lot of those opportunities in any given country, but then also it's global. You can go one country, borrow their
Right.
money if they have a negative real yield, and you can deploy it into assets in another country. So for example, Warren Buffett, he borrowed yen at basically zero, and he bought a bunch of Japanese commodity trading houses and industrial firms with them, and they performed excellently. I actually did a similar trade. I didn't borrow yen to do it, but I was just in that trade unlevered. And even those firms themselves have debt as well, so they're shorting the yen and they're owning better business equity. And then he even layered on top of it by borrowing yen to buy those already levered entities, right? So he's playing the game of blackjack, financial blackjack very well. So for 40 years, that's been the strategy. And that generally contributes to wealth concentration because the large companies and wealthy people have better access to low cost, long duration debt than others. And
Right.
so the larger, more well connected you get, the better. And if you get all the way to the top, then you get to help craft legislation. You get to call the central banker on the phone when there's a crisis and make sure you get liquidity. So for example, during the 2020 crash, liquidity crisis, pandemic lockdown, small businesses ran into credit crunches, whereas the Fed made sure to get corporate bond markets back open. They made
Yep.
sure to reliquify those. It's easier to do that. Even if they wanted to open the small ones, it's just easier to open the big ones faster. And then later, when they said, okay, now we want to try to help the smaller businesses, they did the PPP loans. And if you analyze those programs, and those mostly turned into grants, if you analyze those programs, something like two-thirds of it, there's been really good studies on this, something like two-thirds of it went to the top 20% of the population in terms of wealth. So while it's kind of framed as, helping restaurants get through the lockdowns, for example, which is a noble cause, instead it's there's like investment companies applying for PPP loans. There's law firms applying for PPP loans. There's
Right.
companies that were making software that had no intention of laying anyone off. So it just goes to the bottom line. And so basically stimulus checks and child care tax credits are kind of like the visible stimulus. And then the PPP loans, it's like, okay, we'll give those people 5,000 in stimulus, but the PPP loan recipients, they might get 100,000 or a quarter million or half a million in basically what is a gigantic stimulus check. And so that's kind of the strategy we've been on for a while. And I think where it gets unsustainable is you get rising populism where people they know something's wrong, but they can't quite say what it is. And so
Hmm.
you get more and more kind of populist pushback, more and more demands to spend on other things too then. And then it kind of can continue for a while until it starts to impact things like groceries and oil. And that's when it starts to get messier. That's when it starts to impact corporate margins. That's when, the interest rates start, instead of going structurally down, they start going sideways. And so that game of global blackjack kind of slowly unwinds itself. And I think that's the era that we're kind of shifting into now. But it's not a quick change because the entities that have already been playing that game, they've already locked in a lot of long duration, low rate debt.
Hmm.
And so they still have the momentum from, say, the prior decade. Many corporations have 10, 20, 30-year debt at low interest rates locked in their books. And so that's kind of the shift we're going through, but it's a gradual shift.
Continuing the discussion, Lyn Alden discusses the varying impacts of current economic challenges in the US. She notes the stark differences between struggling industries like commercial real estate and resilient ones like major corporations such as Coca-Cola. Alden highlights how companies with stronger debt profiles, like investment-grade firms, fare better. Additionally, she mentions how oil companies benefit from higher interest rates due to their financial positions. Despite fiscal deficits exceeding $1 trillion, Alden suggests localized recessions amidst overall fiscal dominance. She predicts a scenario akin to stagflation, with nominal GDP figures boosted by government spending, but constrained by global tensions and supply chain disruptions.
If you're in commercial real estate, it's catastrophic. If you're Coca-Cola, you're fine, right? So if you're an investment grade company with fairly modest debt ratios, fairly long, low rate durations, they can reduce their debt over time with incoming cash flows. They can just choose not to refinance or choose to refinance minimal of it, and they don't get the tailwind they had before, but they don't really have a huge headwind either. On the other hand, if you're not investment grade, if your business operations are already challenged, if interest expense is a meaningful part of your income, that's when it's an issue. And so you get a bigger than normal divide between different sectors. A funny thing about some of the big oil companies, they've got, long duration debt and then also a bunch of cash, like cash equivalents. And so they're in the opposite position of banks. They're lending, I mean, they're borrowing long at low interest rates, and then they're holding cash at high interest rates.
Hmm.
And so the higher interest rates go, they're actually like, okay, we're just getting paid more on our spread.
Right.
And so it really comes down to sector by sector. And it's useful to quantify it because, so in the US, there's something like 140 trillion of estimated household wealth. Um, that's real estate, that's stocks, that's bonds, that's all sorts of different assets, business equity, all those things. And so when you hear, 1.5 trillion of commercial real estate equities wiped out, that's somewhere in the ballpark of 1% of kind of aggregate net worth that we have. And in addition, we're dealing with, 1.5 or $2 trillion fiscal deficits. And so you have these kind of bubbles of problems, and in isolation, those are disinflationary and locally catastrophic. But in the grand scheme of things, they're absorbable because of this fiscal dominance, large structural fiscal deficits that we're riding elsewhere. And so that's why I think it really comes down to sector by sector, where you have some sectors that are literally in outright recession and have been, and other ones that are doing fine. And I think the net result is something akin to stagflation, where you have maybe low positive real growth or flattish real growth,
Yeah.
and then you have decent nominal GDP numbers, because the inflation component is fairly high because of, fiscal spending, geopolitical supply chain frictions, kind of the whole tailwind of globalization, which was disinflationary, is also kind of slowly, maybe it's not unraveling, but it's just no longer accelerating, let's say, kind of the conservative case. And without that, that's another kind of cost friction that's happening. And so I think that's where we're on, is a somewhat more stagflationary type of situation, which you often see in emerging markets when they have recessions or when they have issues, they often look different than developed markets have looked over the past, call it 40 years. And I think we basically have developed markets with certain emerging market characteristics.
Thanks for joining our discussion on the US economy with finance expert Lyn Alden. Here's a recap. Different sectors face varying impacts, with commercial real estate hit hard while major corporations fare better. Debt plays a key role, favoring investment-grade companies. Oil firms benefit from higher interest rates. Fiscal deficits top $1 trillion, but are balanced by overall fiscal dominance. Alden predicts stagflation, with government spending boosting nominal GDP amid global tensions. Don't forget to subscribe, like, and share your thoughts in the comments.